Hello and welcome to another edition of our Blackwater ETF Insights series, where we chat with innovative leaders from the ETF and digital assets ecosystem. We're doing a special part series where we're covering global capital markets, and today I'm joined by Peter Harper, who is head of capital markets at Betashares based in Sydney, Australia. It's great to have you here, Peter. So why don't we kick it off with the first question, which is just basically, what is capital markets and why is it important to ETFs?
First of all, capital markets really evolved from a desire by the ETF issuers to assist their clients in achieving both best liquidity in their ETF suite and also best execution, so minimizing transaction costs and spreads when buying ETFs. Obviously, that involved a very heavy educational element in the early days, teaching clients how to transact in ETFs and how ETF liquidity worked. And the reason it's important is that at the end of the day, transaction costs in whatever investment you make and the liquidity of whichever investment vehicle you choose, be it direct shares or managed funds or ETFs, that can have real world implications to your ability to get into and out of an investment and the transaction costs associated with those investments. And so if we can work with our investor base to minimize those costs, we're adding real world value to their investment performance. I think the other factor of why it's important to an ETF issuer as opposed to the client is that if we can help minimize those costs for our client base, it puts our suite in a better position relative to other alternative investments or alternative issuers.
And you mentioned education, and I think there is still a lot of need for education in the capital market space. And you had mentioned liquidity, obviously. And so how would you tell an end investor or even anyone really that you're talking to when you're educating them on ETFs, like what they need to consider when reviewing the liquidity of an ETF?
It's really simple. And at the end of the day, the liquidity of an ETF is driven by the liquidity of its underlying assets. So if you think about it, in our case, one of our most traded assets is the ASX 200 index. You could equally talk about the S&P 500 index. When you think about it, there should be no difference in the liquidity of buying that exposure, whether you buy it directly and go and buy each of those underlying stocks, whether you go and buy it through an unlisted managed fund or that holds each of those underlyings, or whether you go and buy it through an ETF that holds each of those underlyings also. I mean, at the end of the day, you're transacting in exactly the same basket. And so the liquidity of that underlying basket or asset is the primary driver of ETF liquidity. You can't take something that's entirely illiquid, put it in an ETF structure and expect it to all of a sudden create massive volumes of liquidity. So it's always the underlying asset that people should look to first and foremost when judging liquidity. That said, there are some circumstances where, arguably ETFs can have additional liquidity. So, if you go and buy that underlying, say the ASX 200 on market from a market maker, they'll be going and instantaneously buying all of those 200 underlying stocks. And that can be a lot more efficient for many investors than going and buying that basket themselves, and arguably cheaper as well. So there are some benefits there. And probably the final one is there's potentially an additional layer of liquidity that exists with ETFs, in that if you buy from a market maker, they go and buy the underlying stocks, and that accesses the liquidity of the underlying. But potentially there could be other ETF unit holders who are sitting on the offer that you could buy from. And so that's just a transfer of units from one holder to another. And so that's an additional layer of potential liquidity over and above the underlying asset.
So obviously you're based in Sydney, Australia, and I'd love to hear a little bit about how your region differs from other markets in terms of trading behavior.
Yeah, sure. Look, in many respects, we operate very similarly to the major global market. I suppose probably one thing I would highlight is the Australian market is more immature in terms of institutional ETF usage, whereas in many offshore markets, it's institutions that have been driving ETF usage from the beginning. In Australia, the market developed with more retail and financial advisor use. And we're now starting to see the rapid growth of institutional usage in our market. So that's something that's coming to the fore now rather than something that was at the genesis of the ETF industry in Australia. What has really dominated ETF growth in Australia has been both retail adoption and financial planner usage. And so we see a lot of turnover going through major wealth management platforms and they make a bigger contribution to our market in Australia than arguably they do offshore.
What would you say are some of the hurdles in terms of, for ETFs as it relates to capital markets?
Look, I think we've definitely broken the back on the education around how ETF liquidity works. But look, at the end of the day, do you ever stop learning? Arguably not. And so, we're still very focused on bringing new investors into the ETF ecosystem. Whilst ETF adoption has grown enormously, relative to direct shares and unlisted funds, there's still huge scope for ETF adoption in Australia. So every time you bring a new investor on board, there's still a very heavy educational element involved in that. There's also some unique aspects to ETF trading in Australia that arguably sees more trading in our domestic ETFs relative to offshore ETFs. And that can be due to the fact that, for example, the US and European markets are entirely closed during our trading time zone. And so it's important to educate investors around some of those aspects. Take, for example, a lot of investors will just look at the size and traded volume of an ETF. And let's say you are looking at a Japan exposure in Australia or in the US. I can say with a high degree of confidence that, the US-based exposure is going to be bigger and is going to have more traded volume per day. And so a lot of investors look at that and say, okay, well, I'll trade the US listed version. But when you actually think about it, ETF liquidity is based on the liquidity of the underlying asset. Now, the Japan market is open for almost the entirety of the Aussie time zone, whereas it's closed for most of the US time zone. Right. And so little tweaks like that, I think are important to highlight and educate people on. And sometimes there's some of the hurdles we come up against. But I think, again, it comes down to education and all of these are, readily solvable.
And so my last question for you, Peter. So in Australia, do you see more on-exchange or off-exchange trading? I mean, the reason I bring this up is that Europe tends to be almost the complete opposite in terms of the percent of off-exchange versus on-exchange versus the US. So I'm just curious what it's like in Australia.
Look, we're very much an on-exchange market. In fact, I don't even think there's the potential for OTC trades in the Australian market. We also don't have the RFQ systems that most offshore markets rely on very heavily. They haven't been approved by our regulator. So, at this point, I see a very strong path to continue with on-market trading. The one comment I would make is as our market matures, as investors become more educated on ETFs, as institutions become increasingly involved in ETF trading as they already are, I think we'll see more block trades and crossings on market as opposed to, individual, people picking off the bid and offer. Although, that's obviously largely retail behaviour and there's nothing wrong with that. The retail market's growing pretty strongly too, but just by the value traded, I think as institutional usage grows, it'll stay on market, but you'll see more block crossings.
No, very interesting. Thank you so much, Peter. This is really insightful. And for those of you who are watching, thank you for watching. And to watch more videos like this, you can go to our website, which is blackwatersearch.com.